In this video, I'm going to show you how to read order flow on your charts with the use of the candlesticks and how it's going to change the way you trade the markets forever. So keep watching. If this excites you, don't forget to give me a thumbs up and let's get straight into this video. So I'm currently on the DXY. I'm just going to go through exactly how you can apply this technique to your own charts, reading the order flow, and how it's going to help you to dramatically see where price could likely go next. Now this is a technique that will simply just be marking out levels on your chart, waiting for the candlesticks to close that level to show you that the market wants to do reversal. Now traditionally, when we're looking for a reversal in the market, if we're looking at this area here, you would normally be looking for the break of this high to show you a break of structure of this last move down, breaking to the upside. Now, by the time you've seen this, you've missed out on all this price action to the upside. And what if I could show you today a way that you could capture trades all the way up inside these areas with a simple trick of understanding the way the markets move with order flow? Well, that is what I am going to show you today. So keep watching now to the end so you can actually apply this in your own trading. So what we're looking for is simply, we'll leave this level on the chart at the moment, but when we see price, actually let's look at this area down below. We can see the huge movement to the upside as price rallies up out of this low. So there's got to be a reason why we see this reversal. Now if we just go back in the chart, you will be able to identify that we have these lows in the market where price has previously found support or structure in the market. We test this and we see it bounce off. Now that is traditional structure and support and resistance in the market, which to be honest is very simple for you to read. But this isn't what I'm actually going to show you today. What we're looking at is where we see a true reversal happening. Now for this, we can see the market drops here, creates this bullish candle. Now what this is going to create is what we call that drop area of supply. Now what you can also notice that we have this small candle right after that bullish candle, and then we have the big bearish drop. So what we're looking for is where we're seeing the candle before that drop, we're going to mark a line from the low of that candle, and as soon as we identify a close, which is right here on this bullish candle, we now have a shift in direction. So this is showing me now the market is likely to want to go higher. I'm going to show you the second part of this video, how you can actually look to take a trade once we see this. Now looking back in time, we can identify the same situation. We have this level in the market where we see a nice bullish momentum move to the upside after breaking the high of this candle. When the market comes back to this level, we have this reaction where price fails to break it. We have a push up to take the high of this candle, and that comes into manipulations. Now there is much more of this taught inside the Forex Masterclass. So if you're not sure on some of the concepts I'm talking about in this video, I really do suggest finding out more on the Forex Masterclass course and perhaps joining up. But this candlestick alone shows me the momentum drop after we close this level. So I'm expecting prices to fall. So it's quite easy to actually identify these reversals. But what about if you're looking for a trade? Where are we going to target? Well, if we're looking for a trade off this area, my first target would be this level in the market. Just mark it across. You can see when price comes up into that level, we hold. We fail to break, we pull back, and then we have another breakout right here. So again, we see the continuation of that price wants to continue to go higher. And again, we have one more level here in the market. Let's mark that out. And we have another break and close through here. So these three candles demonstrate to me, after closing these levels I've drawn on the chart, that price, and this is the order flow of price, will continue to go to the upside. And it will go to now take this high. So the market at this point is bullish after we see the close of this candle above this level. And then you have these targets, 1, 2, 3 targets that you can use to look for a trade. Now the same applies when we see the market going from this low to this high. We can mark off this low in the market, and this would be a target. We see the pullback on this candle. After this candle broke through, we pull back into the body of this candle. Now this is where we're going to start looking at how you can take a trade. We see the pullback into the body of this candle, and then we drop down to hit this target. So it's inside these candles where you can actually start to look for your trade. Now you can look on the lower time frames here, and you can look for a candlestick pattern, or you can look for a confirmation entry. Now it's key to understand you're looking at these levels for that reversal and the momentum in the candles. Now one more trick, just to understand that momentum break, you can actually pop to a line chart, and you'll be able to see if the line chart is showing you the momentum move up at the same time. But you don't need the line chart. You can identify this just purely on the candles. So you'll be looking here for a pullback into this candle. Now looking where we see the market here breaking, again you'll be looking for a price to pull back into the body of this bullish candle. So we're marking it from the low of the candle to the close price of the bullish candle. And you'd actually most probably mark it from the high of the bearish candle to the close price of the bearish candle. And you'll be looking for pullbacks into this area of this bullish candle, which is actually classed as demand, and this will be actually classed as an area of supply. And again, we do the same thing once again. Once we see the break of this candle, you mark this out as your area of demand. You're looking for price to pull back into the body of that candle to look for your entry. And finally, you'd have it on this candle as well as your area of demand, based on this last bullish candle to the upside. Looking for price to pull back in for your entry to go long. So that is the technique of reading flow of price. Once you understand these levels will show you the reversal, then you're looking for the momentum in those candles breaking these levels. You're then going to use those candles for the market to pull back into. Let me just mark off this candle here. So there is your reversal to the downside, and this is our reversal to the upside. And again, continuation to the upside, continuation to the upside. And you can see every time we have a breakthrough, we pull back into the body of that previous candle that broke that level, and we go for the next level each and every time. So that is understanding, applying it to a candle basis on a 4-hour time frame. And what about taking an entry here? Well, for a 4-hour, I'll be looking for at least a 15-minute or 5-minute entry. Now again, like I said, you can look for just a candlestick pattern, or you can look for a reversal in the market. Let's go to a 15-minute entry. And we're going to start off with this bearish move up in the market. So if you're seeing the market here breaking through, pulls back, oh, just move that line. So we break through, we pull back, and we create this nice bearish engulfing candlestick. You could look to actually trade off that candlestick as an entry, and your target would have been this low in the market. So you have just over a 1-to-1 risk to reward. Now of course you could look for another target to the left. You can see the market does continue lower, or you could even go down to a 5-minute entry here and look for an entry on a 5-minute. Now we will look at this in a moment. Let's look at the next areas. So we can see the market again, we break out, we pull back, and once again the breakout area is this move here to the upside. Now you can identify here that we do leave an area of demand. So you could even look at this area of demand, or you can look for a reversal on one of the candlesticks. So if you're looking for an entry here, we see the market breaks out, pulls back, we go below this low, we create a 2-candle reversal right here in the market, and we rally away. But if you're using this area of demand, your entry, your stop loss, below the demand zone, your take profit would be here. So again, over a 2-to-1 risk to reward on that trade. We will look at a 5 minute in a moment as well. Now going forward to the next area, you can see that we break out here, we pull back on this one candlestick, and we have a nice bullish engulfing candle. So I will be looking at an entry here based on a candlestick entry. And we also pull back into this area of demand at the same time. And the market goes up to the next level, again over a 2-to-1 risk to reward. Now I've used the wrong tool here. We want to buy. We just mark it out once again so you can see this is your entry and there's your profit target. So nearly a 3-to-1 risk to reward. That's using a one candlestick, or you could have used this area of demand, price bounces off. Now again, we have the next area. We can see the price breaks out, pulls back. Now you've got an area here of demand, price pulls into, so you could have used this whole zone as an entry. Now all you'd have is an entry at this level in the market. You'll stop the low of the zone and you'll take profit to the highs. Again, a 4-to-1 risk to reward. So that's just using this area on this bearish candle move down to the upside, an area of demand. Now we've already confirmed this is a good time to take a trade based on that 4-hour time frame. Now if you go down to a 5-minute time frame, you will be able to find higher risk to reward trades. So what we'll do now is we'll pop to a 5-minute time frame, quickly go back to that first entry, first sell, where we saw this area. I said I was going back to look at this. Now when the market does pop up, what we can identify here is we break above this high, we make a manipulation and we close back out. So you may not have actually had a better entry here because you can see the size of this reversal candle is the same. So you're going to have to do some back testing, see how you find this, but this will allow you to read the flow of price and be on the right side of the market. That is the idea of understanding this strategy. Now going back to where we could have taken a buy. When price comes in, we break out and see we rally away. You could have marked out this area of demand. The market comes back into that demand zone. Now, understanding a tested zone, I want to see price come below this area, this low. We enter here once and twice, and this could have been an entry that you take. So if I place on a buy at this level, stop a few pips below the low of the zone, take profit at that high, you now got over an 8-to-1 risk to reward. And that is how you can increase that risk to reward by dropping down a time frame. Now it takes much more than what I'm sharing with you today to take these sort of trades. You need to understand about the use of good risk and money management and understand how to trade with a supply and demand strategy. But this is to teach you exactly how you can read the flow of price with the use of candlesticks. Now let's have a look at one more on the next move we see. Now on this occasion, we were looking at price breaking out here and we pulled back. Now there was no entry. So you'd only be looking for this as an entry on a candlestick perhaps. So again, this would be your entry, stop at the low, target at this level, and just under 3-to-1 risk to reward. So not much of an improvement on that trade. And the final trade is where we break out this level here. Now, if we were looking at an area of demand, I think we were looking at this as a zone on the 15-minute. The market did come in. If you're using a 5-minute, this would have been your zone. And the market just tags right there. Zoom in so we can see this. Just goes into your zone. So again, this would have been the entry. Stop the low. And then your target would have been your previous level. Drag that across. And there's your trade. And now we have a 15-to-1, over a 15-to-1 risk to reward. So you can see that this trade dramatically increased by dropping down a time frame. And that is how you can improve your trading accuracy by using the lower time frame. But remember, the idea of this is to understand the flow of price, not the entry, not the risk to reward, but understanding where the market is heading and how you can read that with understanding what I've gone through in the first part of this video. Now, if you're not sure exactly how to do it still, rewind this video. It's free to watch over and over again, so watch it as many times as you need to understand this type of trading. I assure you it will help you going forward in 2022. But if you're still struggling and you need that help, you need to learn how to trade correctly with supply and demand or understanding smart money concepts, then I do suggest checking out the Forex Masterclass. Now the link for that is below in the description of this video. Now if you've enjoyed this video today, give me that thumbs up. Now of course, if you have any questions regarding what I've gone through in today's video, don't forget to leave a comment below today. And if you want to understand how you can use lower time frame entries with line charts, now that's all about the confirmation entry or the change of character, then that video is popping up right now for you to learn more on how that can help you to find those lower time frame entries and increase your risk to reward.